Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by Michael Ohlrogge, a professor of law at New York University's School of Law. He joins me to talk about his paper, Why Have Uninsured Depositors Become De Facto Insured?, which explores how usual or unusual it is for uninsured depositors to take losses when a bank fails. Professor Ohlrogge's research found that before 2008, it was common for uninsured depositors to take a haircut on their funds when their institution failed. Today, when a bank fails, it's very normal for most, if not all, of the uninsured deposits to be assumed by the acquirer. He also found that these uninsured depositor rescues coincide with a dramatic increase in the FDIC's cost to resolve failed banks. We talk about his research, what may be motivating the FDIC as it assesses failed bank bids, and the implications of his finding in light of Congress considering whether to raise the deposit insurance limit. Banks worldwide use Tactile's AI decision platform to power their credit, fraud, and compliance workflows and adapt them in weeks, not months. Built for banking, Tactile's platform is transparent, audit-ready, and made to test and optimize decisions continuously. Learn more at tactile.com. Hi, Michael. Thanks so much for joining me today.
Thank you for having me.
Well, I am so excited to be speaking with you. I came across your paper last year about how uninsured deposits became de facto insured. And it was really timely then because it was the wake of SVB. And it feels even like it's gained more salience given that we're having a conversation in Congress right now about whether the deposit insurance limit should be raised for certain accounts. So thank you again for this paper and for kind of discussing with me some of your findings. My first question is, can you tell me about your research and how you became interested in investigating whether uninsured deposits had actually become insured over the years?
Sure thing. So I would say my interest in this topic started in 2023, as with many lines of thinking in banking and financial regulation. And every year I teach a course in banking and modern finance at New York University Law School. And I was teaching a course when all of these events of 2023 were unfolding. Which
how timely.
Yes, it was timely. It was also intense. The banking crisis was occurring right in the middle of spring break. And I remember spending the entire spring break frantically trying to understand what is going on and how can I possibly understand this and explain it to my students. And one of the things that really struck me about that crisis is first we had, failures of SVB and Signature, and those were banks where the uninsured depositors were rescued, but they were done so in a way that made sense to me. So the FDIC explicitly invoked something called the systemic risk exception, which enables the FDIC to rescue uninsured depositors of a failed bank, even if doing so isn't the least cost way of resolving the failed bank. And normally that's what the statute requires. The FDIC is to resolve a failed bank in the least costly way to the Deposit Insurance Fund. But Congress, in creating this statute in 1991, I think relatively wisely said there's going to be some situations where maybe the least cost isn't the best.
Yeah.
But we're worried about giving the FDIC unlimited discretion in rescuing whenever and however it feels like. And so we're going to craft something what we're going to call the systemic risk exception. We're going to say the FDIC can rescue uninsured depositors in a failed bank, but we're going to put some pretty tight guardrails on it. We're going to require that the FDIC get approval from 2/3 of the FDIC board, 2/3 of the Fed board, the Secretary of the Treasury, and in consultation with the U.S. President. And since the U.S. President can dismiss the Secretary of Treasury at will, it essentially requires the direct authorization of the U.S. President. And so Congress in 1991 had said, we understand sometimes in really exigent circumstances, it might be necessary to rescue uninsured uninsured depositors, but we don't want it to be something that's taken lightly. We want transparency. We want political accountability. And when Silicon Valley Bank and Signature Bank failed, we saw exactly that happen. The FDIC went to the Treasury Secretary, went to the president and said, we think we need to rescue the uninsured depositors. We acknowledge this is not going to be the cheapest way to rescue this bank. We think it's worth doing. And the president, from what I understand, was not happy about it. It was a tough decision, opened him up to criticism. But when you're president, this is your job, is to make tough decisions. And ultimately, he approved it. So that made sense to me. It fit within the kind of statutory framework that I was familiar with and that I was in the midst of teaching my students. Now, things got a little bit weirder, though, a little bit later in the 2023 crisis when First Republic fails. There we have a situation where, again, uninsured depositors are made whole. And yet the FDIC's Deposit Insurance Fund took around a $15 billion hit from that resolution. And yet there was no invocation of the systemic risk exception. There was no authorization by the Treasury Secretary or the Fed Board or the U.S. President. And that struck me as weird, not necessarily impossible. Maybe it really was, the least costly way to resolve that bank was to rescue the uninsured depositors. But it just struck me as weird. And I was like, how can I explain this to my students? How can I, explain to them, usually I try to find examples from the world and show how they illustrate the law playing out the way that we expect it to. And this was not fitting easily into that framework for me. And so it got me thinking. And as a data person, that's what a lot of my training is. I said, well, let's go to data. Let's go to the history. Let's look at how banks have been resolved in the past. Let's look how often it is the case that we have a situation like we did with First Republic, where we have uninsured depositors made whole at a failed bank and the FDIC nevertheless taking a large loss. And I found some very interesting things that surprised me. On the one hand, I found that in the post-2008 period, it's been incredibly common to have that situation. Somewhere like 94% of all bank failures that we've had since 2008 have resulted in uninsured depositors being made whole. And in almost all of those, the FDIC has taken a loss. But the interesting thing is that when I looked further back in time, I found that this was by no means the only way that this country has been run. And I found at least three major periods in U.S. history where we handled bank failures in a very different way and where it was the norm, or at least a very common occurrence, for uninsured depositors to take losses. And so I would say this all started with me sort of seeing what was happening in 2023, trying to understand how do I fit First Republic's results in with what I thought I understood about the law, about the requirement for the FDIC to use a least cost resolution method to resolve a failed bank and to get presidential authorization if it's going to deviate from that. And then it started me into a much broader history and inquiry into understanding how do we resolve failed banks in this country.
Yeah. So you alluded to, I think, one of the main findings, or one of the most important things about your paper, for me at least, was that the way things are done today and have been done since 2008 is not the way they've always been done. But your paper is actually arguing sort of that uninsured deposits are de facto insured. And maybe that's another finding of your paper. What were some of the other findings that you felt were important to stress from your analysis?
Sure. So I would say a couple of things. So on the one hand, it is true that, I find that, in the post-2008 period, uninsured depositors are, almost de facto insured. 94% of the time when a bank fails, they are protected. Even when they're not protected, the losses are incredibly small. At the same time, I feel like that was not that big of a surprise in a lot of respects. That was my
lived experience.
I know, sure. Exactly. It was my understanding too. Prior to that, I taught, continental Illinois in my class, and I was like, we had a bank failure there. Depositors get rescued, and it's just all been rescues, ever since. And that was what I used to think was true, and that's what an enormous number of people think is true. That basically just sort of this assumption that the post-2008 reality is the only reality that we've ever had, and indeed the only reality that's even possible.
Right.
either due to issues of political economy, that some people have had this notion that it's just politically impossible to allow uninsured depositors to ever take a loss. There's going to be too much political pressure, demanding to make them whole, or it's just an absolute necessity of financial stability that if we ever had, a single penny lost by an uninsured depositor, then there would be mass panic and the entire financial system would collapse. And for either the political economy or the financial stability or some combination of those explanations, I think a lot of people just take it as given that uninsured depositors are always going to be de facto insured.
Yeah.
And so in some respects, when I title the paper, why have uninsured depositors become de facto insured? Implicitly, I'm trying to say it was a definite change that occurred. It's not like, why have they always been de facto insured? And that's the fascinating thing is that I discovered is that there's actually been a nearly century-long tug of war between the U.S. Congress and the FDIC, going back all the way to the very beginning of Federal Deposit Insurance in 1933, where we've had a pendulum swing back and forth between periods in which uninsured depositors regularly take losses and ones in which they almost never do. And that was fascinating for me, both just to understand our history better, but also make me realize, wait, this thing that we take as an unassailable characteristic of reality, like there's no other way to have a U.S. banking system other than rescuing uninsured depositors, there's actually more ways that we can and have done it. And so it was fascinating for me to see that, for instance, even in the very early days of Federal Deposit Insurance, and this is in the wake of the Great Depression. I mean, this is, far more traumatic, disruptive event than anything, than anyone currently in the U.S. has seen in their lifetime, much, much worse than the 2008 crisis. Even in the wake of the Great Depression, when banks failed, an awful lot of the time in the early days of deposit insurance, uninsured depositors would take losses, and people were okay with that, and the world didn't fall apart. But the fascinating thing is, after a while, going into the late 30s and early 40s, the FDIC started to slip away from that, and they started migrating to rescuing more and more uninsured depositors when banks failed. And this, was seeming to continue for quite some time. Until the early 1950s, when Senator Fulbright, who was at that time on the Senate Banking Committee, took issue with this, and he held up the appointments of incoming FDIC directors. And he said, you have a statutory mandate to resolve these banks in the least cost way. I don't think you're doing that. And you're not going to get through my committees until you change your practices. And some of it was a debate that Senator Fulbright was having with the FDIC about the meaning of the FDIC Act and whether or not they were actually required to use the least cost means to resolve a failed bank. The FDIC argued that they didn't need to. They could just rescue whoever they wanted, whenever they wanted, for any reason. And Senator Fulbright said, no, you're reading the statute wrong. And if you want to get through my committee, you got to start reading it the way I say it's read. And that's one of the things you can sometimes do when you're a senator. And so within a month of the new chair being confirmed, he wrote to the senator, he said, we're going to change our practices in the way you requested. We're going to start for the first time in our agency's history actually trying to compute the costs of different resolution methods, and start for the first time actually trying to think about, let's use the most efficient resolution method to handle a failed bank, not just blanket rescue uninsured depositors for a long time. And that lasted quite well, for several decades. That became the norm, that uninsured depositors would take losses when a bank failed. But by the time we got to the 70s and 80s, it started to dip down again. We were getting more and more regular losses by uninsured depositors. Congress stepped in again in 1991. They passed something called FDIC, or the FDIC Improvement Act, that strengthened oversight of the FDIC, put in firmer requirements for them to resolve failed banks in the least cost way. And there was a dramatic change right after that. We go from very low rates of uninsured depositor losses when banks fail to very high, rates, around 60% of the time when a bank failed.
Oh my God. I can't even imagine when you talk about this, like I can't imagine this world.
I know
in the savings and loan crisis, people take losses. In the .com, they take losses. What are you talking about?
That's the amazing thing is I didn't know about this, until I started researching this, and so many people don't. And so many people, it's inconceivable to them that we could have a financial system where uninsured depositors take losses. And yet we had it, for 15 years, and it worked fine. Most of the time when a bank failed, uninsured depositors would take a loss. Oftentimes it wasn't terrible, but you would take a haircut. The world didn't end, the economy kept booming. The financial system, did okay during most of that time. And not only that, costs, the FDIC were super low. Costs, fell, almost in half when the FDIC started changing the way it resolved failed banks in the wake of Fiducia. And then when the FDIC threw that out the window post 2008 and said, let's just go back to rescuing everybody, costs doubled in terms of resolving these failed banks.
So I started covering banking in 2011, and no one sits you down and explains all the rules to you before you start. So you just kind of learn by seeing stuff happen. I'm not 2011. We're not having all the failures, but we're still having failures.
Exactly.
And you see in the releases, the bank has acquired all of the depositors. Like it says what the costs of the DIF are, but it doesn't really kind of break out like, this was the administrative cost. This is the cost of sending all the examiners down there for a weekend. Sometimes it'll say like, we went into a loss share agreement with the acquirer, and you kind of needed that because some of the assets were a little iffy. And, I am aware that like a bidder could include like, hey, this bank is actually so toxic, we need you to pay us a little bit. Or I know that like when First Citizens acquired SVB, they asked for a cash consideration in part just because it's a lot of money for one bank to kind of put out all at once. So that kind of all goes into a bid. And I get that every single bid is like extremely bespoke. Like I understand that, but I was just, like I said, stunned to learn depositors were regularly taking losses. This is back when I know that the DIF coverage, or the insurance coverage was lower at like 100,000. And I just imagine every time a bank failed, between 1992 and 2008, that like some CFO somewhere lost his job over haircuts. Like, do you have any sense of political backlash, criticism of the FDIC? Was everyone just like, oh, shucks, I wish I had more discipline as a depositor on my bank. You got me. I didn't realize it was poorly run, and now we have a haircut.
Yeah. So, I mean, I will say there are, when a bank fails and uninsured depositors take a loss, I mean, there are criticisms. I don't know a whole lot about the exact details, but I wouldn't surprise me that, you had Congress people complaining and stuff. And I mean, the FDIC has put out some documents trying to sort of in oblique ways justify their current practices of always rescuing uninsured depositors. And in one of them, they explicitly say, we're worried that if we don't rescue uninsured depositors, one of us might have to go and testify in front of Congress, and we might get unfriendly questions. And, I'm not very sympathetic to that because it's like, well, that's your job.
Yeah, you are the insurer. That's like insurers deny claims all the time. I hate to be like this. And I mean, one of the things my paper finds is I think we've wasted about $40 billion or more through inefficient resolutions of failed banks. And I'm just like, gosh, if we're spending $40 billion of money so that an FDIC official doesn't need to deal with a couple of angry Congress people, like, I just don't know if this is where we want, the funds in our country going to. So I think there's some, negative aspects. Maybe some CFOs lost their job. Yeah. But it wasn't the end of the world. We did just fine as a country. You wrote that the rise of uninsured depositor rescues coincides with the dramatic increase in FDIC costs to resolve a failed bank, which you said resulted in at least $45 billion in additional resolution expenses over 15 years. Who paid that extra $45 billion?
Yeah, so as the first matter, it comes in the form of higher insurance costs to the banks. And so when I talk to people about this, sometimes people say, oh, well, who cares? It's just the banks are paying it.
Yeah, I can kind of buy the who cares. Yeah.
Yeah, they're like, banks have lots of money, right? That's the definition of a bank.
Bought more insurance. Yeah.
Yeah. And so I think a lot of people just say it's sort of like a victimless, demolition of $45 billion. Yes, we're lighting a bunch of money on fire, but, who really cares? And it's not really hurting anyone. But I don't think that makes a lot of sense because, I mean, if the banks are paying more, where is it coming from? It's not like it's just their, it's going to be either borrowers from banks are paying higher interest rates to borrow money to buy, borrow money to buy homes or to run businesses or things like that. It's going to be depositors are getting worse interest rates on the money they have with banks, or it means shareholders are going to get lower dividends and things like that. And so, wherever it's coming from, it's hurting real people. It's to me, it doesn't seem like a victimless destruction of value.
Yeah, I just it is very reading this paper and rereading this paper. It was interesting because it brought up like, well, what am I supposed to do if I want more deposit insurance? Like, do you really expect me to have discipline? I always think it's like discipline how? Like what? Yeah. I can't get a Camel's report. I can't get the MRAs. I don't know when there's fraud. So what am I supposed to do? Am I supposed to do reciprocal products or have just 1 million bank accounts so they're all insured? And yes, or, or sure. Like, I don't know, I guess I always was wondering, like, what's the social utility of people actively losing a lot of money? Or is 250 just too low? And it does need to be higher to capture more accounts of a certain type or whatnot. But I was like, I kept like psychoanalyzing myself, reading this paper and asking myself how the world should be if like, the world that I've been living in is not apparently following the least cost test.
Yeah. Well, so I think it depends on you're saying, what should I do? I think that sort of depends on the I. I will come out and say the problem of worrying about uninsured deposit is a problem I wish to have someday. I aspire, to have millions of dollars in my bank account, just sitting around. Oh God, what am I going to do with it? Sadly, I've not yet been confronted with that problem. So I think one of the tricky things when people think about this, and I don't think I'm that unusual. I think most people who are engaged in the policy space, either as policy analysts, regulators, even most workers at banks, academics, journalists, and stuff like that. None of us have nearly enough money to ever have an uninsured deposit. And also none of us have the time and interest to be monitoring our banks. And so I think a lot of people think, well, I don't have the time and the interest, and it's not worthwhile for me to monitor my bank for my tiny amount of deposits that I have. And then they extrapolate that to saying, well, because I don't monitor my bank, and it's not worth my time to monitor my bank, it's not worth anybody's time. And how could anybody ever possibly be expected to monitor their bank? And the fascinating thing for me, so much of this project has been about me seeing things that people thought they knew are actually not true. And so one of the fascinating things for me is actually seeing uninsured depositors overall actually do a lot of monitoring of banks. And so one of the things I find is that in the 4 years prior to a bank failing, on average, a bank will lose between half and 2/3 of its uninsured depositors.
Wow.
And it's not a mad rush for the exits at the very end, like some people might think. It's a steady and gradual thing. But at least an awful lot of uninsured depositors out there actually are paying relatively careful attention. There's pretty good research out there showing that it's actually not that hard to figure out which banks are going to fail. And you don't need, it would be nice to have camels and MRAs, but just looking at the balance sheet, you can actually predict pretty darn well. And these folks can and do it. And so a lot of people do. I think that's great. If you don't want to do that, that's fine too. But there's, another thing that so many people know that ain't so is that, that there's no way for anybody to have safe money if it's not in an insured deposit account. And there's lots of other good alternatives. So, on the bank end, for instance, something that some credit unions already do is they actually get private deposit insurance to cover, additional things. So, if you have a bank and they're saying, oh, we can't possibly convince our depositors that we're safe, unless we have a huge, amount of deposit insurance. Well, then, buy some private insurance. Some credit unions already do that. Another thing I would say to that bank is, well, how about having a little more capital?
Yeah,
Which, in the past, we've certainly had periods when banks have had much more capital. Actually, credit unions are a great example, because when they switched to having at least some amount of federal deposit insurance, their amount of capital got cut in half. They started operating with way less capital because their depositors were no longer carrying so much. So I'd say if you're a bank, get some private insurance, get more capital, try to convince your depositors that you're safe. But on the depositors end, if you don't want to be monitoring your bank, and not even every CFO wants to do that, although I think if you're a CFO, it shouldn't be that hard.
Part of the job.
But if you don't want to be doing that, that's totally fine. There's really good options. Put your money into, for instance, a sweep account, which some banks offer, where any amount that's above the FDIC insured deposit limit just gets swept into a Treasury money market mutual fund. It's buying short-term Treasury securities or swept into repo markets, backed on Treasury securities. There are these super safe, super liquid alternatives to deposits that would work for almost any business, as far as I can see.
In banking, conditions change fast. Credit teams need to adapt without sacrificing credit quality, compliance, or control. That's why banks choose Tactile's AI decision platform. It gives teams the power to design, test, and refine credit, fraud, and compliance workflows using AI quickly and securely. With seamless data integrations and built-in testing, every decision flow can be optimized in real time. With Tactile, AI isn't a black box. It's transparent, explainable, and regulator-ready, so banks are always prepared for what's next. For more information, visit tactile.com. So you wrote in your paper that the Deposit Insurance Fund has accrued $131 billion to resolve about 540 bank failures since 2008. During that time, losses that uninsured depositors took were a mere $190 million. So when a bank fails, what kind of costs or expenses does the DIF incur? And how much of that would you say are uninsured deposits? And then what can you talk a little about the least cost test that should be helping us figure out what the cost to the DIF should be?
Sure. So there's a bunch of different questions there. I'll try to do my best to take them one at a time. So in terms of what are the costs to the FDIC or to the DIF when a bank fails, I would say by and large, especially in modern times, the costs are in some respects very simple, but also very opaque, because almost all banks nowadays are resolved via a whole bank purchase. So the failed bank is sold as a whole. That means all assets, all liabilities, including insured and uninsured deposits, to a purchaser. And there is an auction of a sorts that happens there, although as in the paper I say there's some significant deficiencies in the auction process, but there's an auction of a sort that happens there. And basically the bids in that auction are negative bids. So almost all of the bidders are saying, I am volunteering to take all assets and assume all liabilities of the failed bank in exchange for the FDIC giving me a certain amount of money. And that roughly speaking, the FDIC will then choose which of those amounts of money is the smallest that another bank is willing to pay to assume all assets and all liabilities. And so in some respects, what are the costs to the FDIC? By and large, the stuff about like sending some monitors and examiners out there, that's pretty negligible. By far the big cost is paying, these negative bids to whoever has agreed to assume the assets and liabilities. So it's, on the one hand, it's a very simple answer, but it's also a very opaque answer because, okay, well, where is that money going to? And that's a little harder to disentangle. And in particular, you're asking, well, how much of it is going to the uninsured depositors? What my research and calculations suggest is it's actually a minuscule amount that is actually going to benefit the uninsured depositors. And what that means is that even though we've now moved to a system of de facto total deposit insurance where almost all these uninsured depositors get rescued. I think we're doing it in an incredibly wasteful and inefficient way, even if that was the policy goal to start with, which is not a currently statutorily authorized policy goal. But even if you say, hey, I like that policy, we're doing it in an efficient way. So why do I say that? So from 1992 through 2007, like I said, we had this period where 63% of bank failures result in uninsured depositor losses. But on average, when an uninsured depositor had their bank fail during that 92 through 2007 period, they only lost on average 3.7%.
Oh, that's nothing.
I know, that's the thing. It's nothing, and so it wasn't even that bad. Now, of course, there was a high variance. Sometimes it was higher, sometimes it was 0, but on average, it was not that high. Now we're at 0.1%, 10 basis points, So we've gone from 3.5% or 3.7% average loss to 0.1% average loss. And if you look at the total amount of uninsured deposits at all the banks that have failed post 2008, that translates into about an extra $4 billion of protection that we've given to uninsured depositors. In other words, if uninsured depositors post 2008 had taken losses at the rate they had taken from 92 through 2007, that would only be an extra $4 billion of costs. And yet what I find is that FDIC resolution costs have increased by about $45 billion.
That is, someone's finding an extra $40 billion somewhere. You know what I mean?
Well, yeah. Or I would say somebody's setting on fire an extra $40 billion somewhere. And basically what my analysis suggests is that most of that comes from the inefficiencies that the FDIC has introduced into the resolution process. And so this gets into questions about how are we going to resolve a failed bank. There's different mechanisms that the FDIC can use. And so like we've been talking about, right now, by far the dominant method is this whole bank sale, or a purchasing bank buys all of the assets and assumes all of the liabilities. But from 92 through 2007, that was actually not the main way. The main way was what was called a partial bank sale. And so for that, the FDIC had the flexibility to split up a failed bank's assets, which is oftentimes very popular among bidders. Now, why is that? At least one of the reasons is oftentimes a failed bank is going to have a big portfolio of non-performing loans. Healthy banks that are bidding on a failed bank's assets are oftentimes not thrilled about taking on a big portfolio of non-performing loans. They might not have the infrastructure to deal with, all of those non-performing loans and to shake down the borrowers. They might not want the reputational risk of being the big mean person who's coming and throwing businesses into bankruptcy and, foreclosing on loans and things like that. So they don't want these assets. By contrast, there's distressed debt investors who this is just what they do. And they're happy to bid on them. And so oftentimes what would happen in the 92 through 2007 period is the FDIC would enable a failed bank's assets to be split up. And they said, let's take the different assets and sell them to the different highest value purchasers, sell the performing assets to a healthy bank and sell the non-performing assets to a distressed debt investor or someone like that who's willing to take that. And what the FDIC found is that when they did that, they got much better prices for failed banks' assets. Now, the FDIC hadn't done that until 1982. They didn't do that until Congress forced them with FDICIA to start thinking more seriously about cost. But once Congress forced them to do that, they said, okay, maybe we should think about doing what Congress has passed in their laws. And it worked really well. Now, post-2008, though, the FDIC has basically thrown this notion of a partial bank resolution out the window. They're essentially always requiring failed banks to be purchased, as a whole. And what I think is going on here is that healthy banks, they're saying, if you're forcing us to buy a lot of assets we don't want, okay, we will buy them, but when we're bidding on them, we're not going to give you a good price. And so I think most of this extra cost is not coming from any kind of benefit to the uninsured depositors. Instead, it's coming from the purchasers of failed banks giving much worse prices because they're being forced to buy stuff that they don't want to buy.
And so
the FDIC is required to accept the least cost bid.
Yes.
And then when I was reading your paper, you and I both know that they're very secretive about their bid, the bidding process. There's no information available about like, this is how we weight bids. This is how we like it. They make it seem like when I spoke to them about how to buy a failed bank, it kind of was like, give us a bid and then we have this proprietary formula and then we'll run stuff and it'll like figure out the total cost to us. And we want conforming bids and non-conforming bids. Submit as many, like bidding is free. So submit as many as you want because we want a really competitive process. But they don't share the formula and the weighting. And then they also don't really share always like enough information, deliberately enough information about the bids to kind of reverse engineer, okay, well, this one would have been like, I don't know, it probably would have cost less in money, but maybe more in time. And when I was reading your paper, I was like, for me, my guess is like, they just clearly changed the weighting of bids and that whole bank bids were seen as just more attractive. Like they just got like a weight on them assigned to them. And then the like pick apart deals or like, I don't know, the deal for SVB's wine portfolio that gets like the FDIC just doesn't want to manage. Like they don't want to be the distressed debt investor. They don't want to, or they don't want to like kind of manage just two separate bidding processes when you can just manage one. What do you think about that theory? Like, why do you think that the FDIC had this mission drift? Do you really think it's just one guy who like doesn't want to answer questions before Congress? Or do you think there was like changes in the formula?
So I think there's a lot of things going on. I think it's hard to nail it down all to a single explanation. But I do think what you say is one of my theories. I have about four or five theories. Okay. And as far as I can tell, I think they could all have some truth to them. Sure. So one thing is, yes, it's simpler and easier and faster and quicker for the FDIC if they just sell the whole bank as a whole. Yeah. I'm very unsympathetic to that because, the amount that we're spending on these resolutions frequently dwarfs the entire operating budget of the FDIC. I forget what it is. I think it's $1 billion or $2 billion a year. It's
if you never calculate how much money you're wasting with bank failures, you never have to really deal with it.
I know. And that's the depressing thing, too, is I think the FDIC is paying absolutely zero attention to cost. I spent a lot of time in this process talking to very high level officials with FDIC. And I went into all these meetings trying to be very open-minded and just saying, why have FDIC costs doubled recently? And almost without fail, the first response I got was, what? They've doubled? As far as I could tell, almost none of the top people that I talked with at the FDIC, were even paying any attention to this and just didn't think it was part of their job, to give any consideration to resolution efficiency. And which baffled my mind because most of the time that's bigger part of the FDIC's costs than actually running the entire rest of the FDIC. So I think one of it is this notion of ease, which I think is a very bad false economy because spending a little bit more staff time and effort, I think there's very good evidence results in huge savings. I think there could also be a sort of a path dependence thing about institutional competence, because once we get to the point where it's been so long now since the FDIC has resolved any meaningful number of banks through anything other than a whole bank sale, I worry we're at a point where there's just so few staff people in the resolutions division left who've ever done anything different. And so, I think that's one of my concerns too, is just the people who know how to do anything different, have just retired or left or, had whatever other things have happened to their jobs. I think another thing that possibly might be going on is a bad selection bias issue. So basically one of the things I find right now is the only time post 2008 that a bank is resolved in anything other than a whole bank sale is if the FDIC can't get a single bid on that bank for a whole bank sale. So it used to be from 92 through 2007, the FDIC would regularly reject whole bank bids. in favor of partial bank bids because they were lower cost. The FDIC has essentially stopped doing that. It will only ever do anything other than a whole bank if it's forced to, because it can't get a single whole bank bid. But what that means is that if anyone at the FDIC does at least a superficial analysis, they'll say, well, let's look at the banks that have been resolved through something other than a whole bank bid. And they'll be like, oh my God, the losses on these are terrible. Anything other than a whole bank bid must be, a really, really terrible decision. When it's like, well, yes, when the only time you will do it is when a bank is in just such horrible condition that nobody will buy it, as a whole for any amount of money.
Yeah.
Yes, those ones do now look like they have really high costs. But the only reason is because you've had your sample just badly biased. I worry that there might be, it's a very basic, it's a very dumb statistical error, but I worry that may be influencing it. I think some of it has to do with so some notions of sort of risk aversion combined with not very solid thinking.
Okay.
On the part of some of the FDIC officials. So I think there's, again, one of the things that's striking is from this project is so many things that it's uncovered where people sort of knowing things that aren't so. And so many people just have this notion that if ever a bank fails and uninsured depositors take a loss, the risk, it's going to be catastrophic for the financial system. So I worry that maybe some people in the resolutions division, have this notion of just
they just assume it would be really bad because they also don't know about the 1992 to 2008 time period.
Exactly. So I worry about that. And the unfortunate thing is Congress was very aware of this being a problem. And that's why Congress very explicitly said, we do not want FDIC officials making the decision about whether to rescue uninsured depositors or not. Like Congress said, we understand. And there's like explicit things in the Senate Banking Committee in their hearings and their write-up on this FDICIA law in 1991, where we were creating this least cost test, this requirement of resolving failed banks in the least cost way to the Deposit Insurance Fund, where they said, we don't trust the FDIC staffers to make this decision. We need this to go up to a higher level of decision-making authority and accountability. We want the Fed board involved. We want the Secretary of Treasury involved. We want the president involved. But I think there's some FDIC staffers who don't like that, who just sort of say, hey, I should get to make all the decisions. I know Congress has said I shouldn't do this, but I know better than Congress. And I'm just going to do what I think is right. Mm-hmm. So I think there's that, which I'm one of the old-fashioned people, which is sort of out of vogue these days, who thinks that when Congress passes a law, we should follow it. But I think there's value to that. So I think that's, one of the concerns. Too. So I think there's a lot of different. I think also from an individual staff person's perspective, I've heard some people express to me that well, if I do anything other than a whole bank bid, and the FDIC retains an asset, what if there's some, residual risk with that asset and ex post it ends up looking really bad, and so that could be bad potentially for an individual person's career, even if it's sort of the right decision overall to be doing, a partial bank bid. But the thing is, when you do a whole bank bid, you never know the counterfactual. You can never prove that it was a bad decision. Because you never know what the cost would have been in a partial bank bid. Whereas if you do a partial bank bid and you reject a whole bank bid, then even if 9 times out of 10 that partial bank resolution is cheaper than the whole bank bid that you rejected, there's going to be that one time where it ends up costing you more. And then someone, can be like, oh gosh, you must be so stupid. Why didn't you take this, lower, cost partial bank or this lower cost whole bank bid? And so I worry that there's also potentially an element there. So I think there's, a lot of different things. It's possible it's a single one that dominates over the others, but it seems likely to me that they all are sort of contributing together.
And it's funny because your research started out with SVB and then mentions First Republic. So First Republic has a systemic risk exception. And I feel like looking at the media and politicians at the time, the systemic risk designation for SVB and Signature, you like it. And for you, it makes it very clear that the FDIC is one, authorized to cover all insured depositors. Two, they do not have to necessarily follow the least cost test there. There's like a weird wrinkle about that. And then when First Republic fails, the FDIC does have to follow the least cost test, and as a result, JP Morgan ends up winning. And I think at the time, the question was really like, should big banks really be allowed to participate in this process? And because of the systemic risk designation with SVB, the FDIC could pick a smaller bank. They didn't have to pick like the biggest bank in the country that could, handle and probably price it more competitively. And now in Congress, we are talking about not necessarily the FDIC being more disciplined and following its rules and us telling depositors and CFOs to do their job and being disciplined. We are trying to figure out how we can expand deposit insurance legally, explicitly, when your paper actually pretty argues this is not anything we need to be like quote unquote concerned about, because if any bank fails, it'll probably be insured. I'm sure that's not the takeaway you wanted from your paper and how I'm applying it.
Sure.
I want to know, like, how has your paper informed how you think about the question about deposit insurance coverage and the application of like, do we actually have unlimited deposit insurance? And what should we do? What should Congress do today? Should Congress actually raise it and then really make the FDIC follow its own rule, or what?
Well, I think my preference would be not to raise deposit insurance. I don't think we need to. And
is it because it's already de facto insured, or because you think
I would say because, and then my second preference though is that Congress should tighten the screws again on the FDIC. and some people say, oh, that's never going to happen in today's political environment. And, maybe that's true. Maybe it's not. I mean, one thing I will say from my paper is it shows we've done this several times in the past. Congress has multiple times in the past acted to rein in the FDIC. So I think it really is possible. Some people say, oh, it's totally impossible. I'm like, really? But it also shows, my paper shows the reaction is by no means instantaneous. I mean, we can spend, a decade or two or more, in the FDIC going wayward before the Congress reins it in again. So, I'm not holding my breath on it happening immediately, but I think there's very real reason to believe it could happen, at some point in the not horribly distant future, that the Congress will pull in the FDIC again. So that would be what I would like the Congress to do. In terms of, this current bill about expanding deposit insurance, again, I would say so much out there that people talk about when they talk about deposits and deposit insurance is based on things that people know that ain't so, and so people, have this notion of like, oh, if an uninsured depositor ever takes a loss at a bank, the country is going to fall apart. It's just not true. Or people have this notion of like, oh, if you're a business and you have, money in a bank above the deposit insurance limit, there's nothing you can do to keep that money safe. The only possible way you can keep it safe, is with a higher deposit insurance limit, and it completely ignores these things like, private deposit insurance for the bank, money market mutual funds, sweep accounts, all of these things. I mean, the FDIC wrote a whole document a few years ago on deposit insurance reform, never once even mentions the notion of a money market mutual fund.
They can't acknowledge the existence of other products that would compete directly with deposit insurance, right?
Yeah, exactly. I mean, I understand sort of why is they sort of don't want money moving away from banks, but part of me feels like, if a bank can't give its depositors enough confidence to keep their money in the bank rather than in a money market mutual fund, then I'd rather see it, in that money market mutual fund. So I think banks should need to do some work to earn, their deposits rather than just taking them as a God-given right.
So when I read your paper and I tweeted at you about this, or I tagged you and I didn't tweet at you, I would say that whether I think the value of whole bank acquisitions, FDIC assisted acquisitions, is actually worth $45 billion, I can understand the social utility of just making sure all the customers move over to the new bank, making sure the loans move over. The idea that a bank is probably better positioned to work through credit or sell assets than the FDIC, who maybe as an insurer or as a regulator doesn't really see that as part of their core mission. And so I can kind of like understand why I live in the world that I live in. Mm-hmm. Although I would be very interested to live in a world where uninsured depositors, even if they don't take big losses, the question of whether you would take a loss, I think would be really interesting. You're bringing up today, deposits maybe should move out of the banking system. If they can't like stay in, then maybe they should move out. Yeah. And I think, banks are trying to grapple with this argument right now with the cost of the increased deposit insurance versus like, how can I use private or manage our bank to be safe. How do you think the banking industry would look if we reverted back to this time period where depositors take losses and failures, even if they are only about 3% on average? The money is still frozen, or like you get your insured amount immediately, and then you kind of get cashed out later as they dispose of the assets. So there is like a kind of a time where you maybe don't have access to your money.
Yeah, although that time may be quite short. So oftentimes what the FDIC would do in the past when you would have a bank fail and uninsured depositors is they would do a quick initial assessment of how much do they think they're going to recoup on the bank's assets. And they try to be relatively conservative, but not like crazily so. And so if you're an uninsured depositor, you'll get all of your insured amount. And then you would get, oftentimes a pretty decent chunk of your uninsured.
So like a percentage of your uninsured.
Yes, exactly. Okay. And then if after the FDIC recoups on the failed bank's assets, they have more left over, than they'll give you additional stuff. So you would still get access to your money pretty quickly, but maybe not quite as much. And if you needed it, even quicker, you can sell your claim, to someone else who will give you cash for it now. And people, even when SVB failed, when people weren't sure if they were going to get rescued or not, there was an active market of saying, sell us your SVB accounts, we'll give you some haircut on that, and then it'll be our job to, bear the risk. So, I think if your need is for quick, access to your cash, there's ways to get that. You will take some losses, but I think that's appropriate, and I don't think it needs to be a devastating loss of liquidity that's occurring there. Yeah. And in terms of what would the world look like, it's hard to say. I mean, I think it's naive to think that depositor discipline on its own is sufficient to ensure a perfectly stable banking system. I think we have several highly imperfect methods of trying to ensure bank system stability. We have regulations that, in large part try, but are relatively imperfect. And, you'd hope that if a bank is obeying all the regulations, it's safe. And oftentimes that's true, but not always. We have bank supervision, which in theory is sort of, trying to, fill in gaps in the regulations, and maybe you're, obeying the letter of the regulations, but there's other issues of concern, that's another pillar. And then, I think a third pillar is this sort of market discipline, depositor discipline thing. And I think it would be incredibly naive to think any one of those systems on their own is going to be sufficient to ensure banking stability. But I think there's a pretty good case to be made that they can be overlapping and complementary towards each other, and that you can enhance the overall bank stability when you have that. And there's relatively good evidence, for instance, from other countries. Yeah. We don't have as much evidence from the US itself, but that there's sort of, a curving relationship between deposit insurance and financial stability, that you get initial benefits from increasing it, and that can really help financial stability overall, but you get too high in your deposit insurance and it starts having a negative impact on financial stability. It's hard to prove that that's really what's happening in this country. Many of the other countries where the studies have been done have regulatory and supervision systems that are not as solid as the United States. So I think we need to be moderately cautious, although some of the evidence is things like, looking at even in the US, what happened with credit unions when they got federal deposit insurance. They go to way lower capital levels. They start operating in riskier ways. So I think there is a reasonable but not ironclad argument to be made that we would have at least a somewhat more stable financial system. I will say in particular, I think there's a reasonable but not ironclad argument that the 2023 crisis would have been less bad. And so one of the fascinating things is from the period between 2008 and 2023, we saw a large increase in uninsured deposits at banks.
Yeah.
Interestingly enough, though, the largest banks actually were largely flat on their amount of uninsured deposits relative to their total assets.
Okay.
Instead, the big buildup was in small and regional, mid-sized banks. Those were the ones that were really juicing up on their uninsured deposits. And then what did they do with that? They took the money and they did interest rate gambles. They said, we're going to pump all of this into treasury and agency securities that have long durations. We're basically just going to use all of these uninsured deposits, not to even do the core function of what we want banks to do, which is to lend money to people and businesses, which they may have certain unique advantages of doing, but instead we're just going to use all this money to go gamble. And so I think there's a good but not ironclad argument that the 2023 crisis may have been less severe if we would have had uninsured depositors.
If we were putting losses on those uninsured depositors.
Yeah, exactly.
Yeah. I was talking with my coworker, Alex, about the $10 million deposit insurance proposal. And I mentioned your paper and I was like, I don't think it's necessary at all because apparently deposits are just it was interesting because I think the proposal speaks to the idea that you might take losses and is trying to address that. But your paper just shows we just don't live in a world where depositors are taking losses and we have decided, or the FDIC, when I say we, the FDIC has decided that's part of its that's just a social good and that we're all just going to pay for it on the back end so that we can't even imagine the reality where they would take losses. And I think that's I think that's one of the more interesting thought experiments that your paper has brought up for me.
Yeah. And I would say I'm not even totally convinced that they've decided that it's a social good. I mean, I think to some extent they might have just decided it's a private good for the resolution people, or, it's not clear.
Yeah. Well, Michael, thank you so much for speaking with me today. I really appreciate your time in explaining this paper and its implications.
Yes. Well, thank you so much. It's been a pleasure.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.